Well, good morning. Let's get and I want to welcome you to another episode of the Chimney and Fireplace Success Network. And today we got a really interesting guest as usual. And we're going to be talking about is your exit plans. And if your exit plan includes selling your business, this is going to be a really great process because our guest today is a gentleman by the name of Jim Gaulke. And Jim is a business advisor consultant for Sunbelt Business Advisors. And we're going to be asking him some questions to help you get prepared of how to sell your business. So, Sheryl, you want to go over a little bit about what we're going to talk about today?
Well, as a lot of people now are trying to sell their business, they're not so aware of the conditions that need to be in place before they do that if they want to get the marketable price. And Jim is going to be helping us with some of the situations that need to be carried through here to become a sellable business.
Okay. Brandi, what would you add in about today's broadcast and what our value is going to be here in today?
Well, our industry, we have a lot of people aging out and not so many younger ones coming up. So as they begin to think about selling, we'll ask Jim, but in my opinion, they need to be preparing definitely 3 years in advance, but probably closer to 5 years in advance. And I think what we often see is they just wake up one day and they're tired and they're all sell it, but there's no preparation. And that can really hurt the value that they're going to get.
That's exactly right. So hang on. We're going to be right back. We're going to play our little intro. We'll be back with Jim Gaulke, and he's coming up to us today from Brookline, Wisconsin. That's okay, Brookfield, excuse me. So we'll be right back with this. Okay, so welcome back. So, Jim, I want to welcome you to our broadcast today. And like I said, we're going to be asking some questions and going through some different things. But I want to tell everybody my reason for doing this show today in this particular subject matter. I'm seeing a lot of people that are at the point of they're deciding to sell their business. They're deciding it's time to retire. They're ready to give up. But on the other hand, I also know of a young couple that recently put their business up and put it on the market because they wanted to do something different. So now if you're in your 20s, your 30s, your 40s, your 60s, no matter where you are, if you build a business, there may come that day. And the whole thing is, if you're a self-employed person, I can bet you have poured your blood, your sweat, your tears, your heart has ached and all the pain you've gone through. So when it comes this day, often people decide one day, I want to sell. And when they do that, commonly they're going to get a business broker involved. If they're very smart at all, just like selling real estate, it's really tough. So Jim, tell us a little bit about yourself and what qualifies you because you came to me highly recommended as a subject matter expert in this. So tell us a little bit about your background to get started.
Okay, well, hey, thanks for having me on here, and thanks for pumping up my self-esteem by saying I was highly recommended. I'm liking all of that so far. My background, I have personally owned two businesses myself. I've been with Sunbelt now twice as a business advisor and broker. I had my first business for 20 years. When I sold that business, I did everything wrong. And I learned a lot of lessons. And I came to Sunbelt. I worked here, bought a second business. When I sold that business, I did it the right way, and it was a lot less stressful. It was a smoother transition. And the big thing is my walkaway dollars were better than they would have been had I not known what I did from being a broker and from selling my first business. So that's kind of my background. I've been with Sunbelt with both times, a combined total of about 8 years now.
Okay. So anyway, I'm a person that actually put a business on the market back in the 90s. And believe it or not, I actually contracted with Sunbelt in the Charlotte market area to list my business for sale. And I can still remember the day there was two brokers came and interviewed me in order to secure the account. And I asked them right off the bat, I said, well, what's my business worth? What's it going to sell? I had no idea what we were getting ready to go into. And their answer was, well, Jerry, it's all about the numbers. It's all about the numbers. But it's actually all about the numbers, how they're presented, and everything that goes with it to come up with that. So my first question for you, and we're going to kind of jump around, does the usual person that owns a business that comes to someone like you, do they realize the information they have that they're going to need to provide, and are they prepared with that information?
That's a really good question. And in most cases, they aren't prepared. They don't understand how the business is valued. And frequently, their idea of what the business is worth is far greater than the actual worth of the business. So it's our job to educate them to the process, how the business is valued, and then move forward from there.
Got you covered. So, Brandi, I'm going to start with you. You go first. And what's your first question? And Jim, I'm going to warn you. I guarantee she's got a stack of notes there. But to be honest with you, I do too today, Brandi.
I like what you said at the outset here. I mean, she was spot on when she was talking about how people are not prepared for businesses. It's something that I see on a daily basis.
Yeah.
Well, and I'm going to make that my first question. So let's say that I am, well, I'll just use myself as an example. I'm in my 40s. That's all we'll say. And so let's say I want to retire at 50. How soon do I need to start preparing, and what are some of the things that I need to do?
You should start preparing right away, right now, today. Someone buys a business, and I kind of joke with them. I'll talk to them, follow up with them a few days later. I said, well, have you got your exit plan in place? Geez, I just bought it. Well, at some point, all those businesses are going to sell, or they're going to close their doors. Selling it is a better alternative. So understand the process, how the business is valued, and what's going to add to that value of the business, and incorporate that into your business plan from day one.
Okay, so incorporating in there. Brandi, does that cover your question pretty well?
It does. I may ask for some clarification later, but I don't want to hog the question time.
No, wait a minute. You usually don't mind hogging the microphone. So, Sheryl, what's the first question on your mind for Jim?
Basically, it's a statement that will lead to a question. I see people when they're going in.
Sheryl, you broke up there a little bit.
I see a lot of times when people are looking to sell their business, they value their database at an extremely high amount of money compared to their tangible things. Could you explain why that really does or does not work?
Well, they say, well, I got this database of customers. There's got to be some value in that, or I've got these hard assets or intangible assets. And there's a short answer to that. Those assets, those lists, tangible, intangible assets, they're worth the amount of revenue that they produce. I get it. It comes down to a number. When someone buys a business, it's really nice to see that they have all these things, but if they're not producing revenue, they really don't have any value. Because if somebody buys those assets, tangible or intangible, and they pay a certain amount for them, those assets have to provide two things. Number one, they have to provide enough revenue for that buyer to pay the debt service, basically pay their loan. And then after they do that, there has to be enough of that revenue left in order for them to live on and take as a salary.
Okay. So we have a question from the audience, Jim. I'm going to read this. I presume you can see it on your screen. But does a company's reputation in their market have value to what the business is worth? We have the most amount of 5-star Yelp reviews and have earned the Angie's List Super Service Award for 11 years. Is the value of the business solely based on the P&L, which is a profit and loss?
It's not based solely on the P&L. Your reputation in the marketplace is going to have a bearing on it. But the most heavily weighted by far is what the value is on the P&L. A good example, I just had one the other day. Somebody approaches me, and before I do a little front-end research, I go to their website, rated on Google, and they had a 5-star review. And once I looked at their books, they're losing money. So how much is that 5-star review worth? What would you pay for that? If you're a seller, you have to think a little bit like a buyer. Look, if I'm a buyer, I well, geez, I look at it, it's like, yeah, they've got 5-star reviews. They must be making a lot of money. Well, when you look at the numbers and you find out they're actually in the red and not making money, what is the value of that 5-star? Now, take the reverse of that. If all things equal, let's say I got 2 companies that are showing a similar company showing a similar amount of profit, bottom line revenue. One of them has a really lousy reputation in the marketplace, and one has a really good reputation. Well, the one with a good reputation is going to be more desirable of those businesses because, the sustainability of that business going forward is better because they've got a good reputation in the marketplace. The one with the bad reputation, perhaps the new owner can turn that around, but there may be some issues with that continuing going on to be profitable with a bad reputation. They may start losing customers.
Gotcha. So it could be a selling feature, but it may not add the value that people would think. Is that what you're saying, Jim?
Exactly. Yes.
Okay. So I've kind of got down here that one of the first steps of determining the sale value is going to be a valuation. And that's one of the things that I believe as a broker you provide. It's kind of like a real estate agent, and they will do a anticipated selling cost proposal for the home that's selling real estate. It's very similar. So how do you do a valuation? Because I'm presuming that's one of your services. Would I be correct?
You would be correct. And we do provide valuations. And that's a very critical piece, obviously. We have to know, number one, the seller has to know what their business is worth. I have to know what it's worth because I got to know whether it's something I want to take to market. Is it a saleable business? So what we do is we typically would look at 3 years history of the business on their financials, the profit and loss statements, or the business tax return. And when you look at a business tax return, a lot of times you look at it, you see net profit. That's rarely an accurate indicator of what the business is worth. Why? Because if you got a good accountant and you're a smart business person, that net profit, you don't want to show any more than you have to because you want to minimize your tax liability. How much do I have to pay the government? So there's going to be deductions taken out. And as part of my evaluation, what I have to do is find those deductions and then add them back to that net profit to come out with the actual financial benefit that business has to the owner of that business. For example, a tax return, you'll see a line on there, excuse me, for depreciation. A depreciation is a paper loss, and it's a legal deduction that the government allows you to take, but that's still money that goes into the buyer's pocket. There may be things that are expensed on there. Sometimes sellers will expense their vehicles, cell phones, different things. Those are still financial benefits to the owner of that business. So those things have to be added back. There may be interest on there. That would get added back because somebody buying your business, they're not buying your debt or the interest that you're paying on that debt. So that would get added back. And then we come back, we call it a financial recast. So once we complete that recast, we come out with a number that we call either seller's discretionary earnings, what we call it. Some brokers and advisors will call it seller's discretionary profit, seller's discretionary cash flow. They all are the same thing. And that is typically the number that we'll use to value the business. Now, on some deals, larger transactions, I'm talking probably 5-6 million and up, they'll use another number. It's called EBITDA. And that's a whole other thing. I'm not even going to try to explain that right here because primarily my focus is Main Street and smaller and middle market businesses. And typically, the best way to value those is to use that SDE or seller's discretionary earning number.
Well, and Terry just asked the question if it was based on exactly, which is, if I guess that's what she put on the screen. Am I correct, what you just said?
Right. EBITDA is earnings before interest, taxes, depreciation, and amortization. And typically, when you get into larger merger and acquisition transactions, that's the way businesses are valued because they're structured differently, and that's generally a better way to do it. But when you do it on a Main Street or a small or a middle market business, the SDE is generally going to be the number that's going to be the most accurate. It's typically what a lender is going to look at, when it's typically what a buyer's and accountant is going to look at. So it's easier for us at the end of the day to say we valued it on this, and we can defend that number.
Gotcha. And most of the people that are going to be listening to us are going to have a business valued less than $5 million. So that's your specialty, is small business, not $100 million corporations, is what I'm hearing.
No, we've got an M&A team, a merger and acquisition team that does. Somebody comes to me with a business that's a $50, $100 million business. That's something that I refer off to. It's just not part of what I do. I specialize in the Main Street businesses and the middle market, up to about sale prices of up to about $5, maybe $6 million, depending on the type of business and how it's structured.
Gotcha. So that's dead on what we're talking about here. So Brandi, you're up. What's your next question out there from Kansas City?
Yeah, so I have had a lot of friends buy businesses, and I know when they're looking, they always have to sign an NDA. And I guess I assume that's something that you would really recommend that somebody puts in place before they give away all their numbers.
Yes, I didn't know you're from Kansas City. Our Packers were just out there, and you beat up on it pretty bad. So I won't hold that against you.
Well, the Chiefs aren't having the best year, so.
Okay, repeat that question again. You broke up just a little bit again.
Yes. So I have a lot of friends that have bought businesses, and when they're looking at different businesses to buy, they always have to sign an NDA before they can look at any of the financials, any of the information. I assume for our listeners, that's something that you would recommend.
Oh, absolutely. Confidentiality in a business transaction is very critical. If somebody's selling a business, their customers find out, customers may leave. If their employees find out, their employees may leave. If their competitors find out, their competitors against them, and it could hurt the business. So confidentiality is extremely important. When we vet a buyer, we generally find out, first of all, if they have financial resources in order to buy the business that they're required to buy. If they don't, we stop right there. There's no sense of going on any farther. Because why risk confidentiality with somebody that just doesn't even have the means to buy the business? If they do have the means, the financial means to buy the business, then we will have them sign the NDA, the non-disclosure agreement, which basically says, when we share this information with you, confidential information about the business, financials, the identity of the business, you keep this confidential. You can share it with your trusted advisors, your attorney, or your accountant. But beyond that, it's as far as it should go.
Gotcha. And so in case you don't know what NDA stands for, that's a non-disclosure agreement. That is a legal agreement not to share secrets. Here is what we're talking about there. Okay. So Sheryl, what's your next question?
Okay. We have seen quite a few companies that were at one time larger. I'm going to use 5 trucks as just a marker. And now they've got 5. They had, prior to, say, the last 2 years, they've had 5 trucks and they were running steady. And then they dropped back because a lot of times of an employee situation to 1 or 2 trucks. How much of an impact does that have on a buyer that you're discussing with?
Well, again, it comes right down to the bottom line number. How is that affecting the bottom line number? And then I think what you're also talking about too is trending. Is the business trending up or is it trending down? Sales are going up and bottom line revenue is going up. That's ideally what a buyer wants to see. Also, is what a lender wants to see. Now, if a business is trending up and all of a sudden, like you said, that for one reason or another, you're taking vehicles out of service, business is going down, and the numbers on that business are trending in a downward path, it's going to affect the value of the business from a buyer standpoint, and it's also going to throw up a red flag with a lender if you do get a buyer to come in on the business. Now, there are exceptions to the rule. One really good one is what happened in 2020 with the pandemic. A lot of businesses shut down, and that really it really added a new piece to the equation when we value businesses. In a lot of cases, we had to take 2020 and throw it out, look at 2019 and see how the businesses are trending in 2021. But that's the exception to the rule. Generally, if a business is trending up or down, it is going to impact the value of the business. Trending up, it's going to have a positive impact on it. if sales and revenue are trending down, it will have a negative impact.
Right. So selling in a down economy can hurt the value. Selling in a bull market economy can help the value. Did I just hear you say that correctly?
Not necessarily. I've seen some businesses in a down economy who have done very well.
Okay.
And it's just the opposite of that. And it depends on really the business. Now, there's outliers to all those. I mean, if you have a down economy and there's one industry as a whole that's taken a hit more than anybody else, and there's a legitimate reason for it, it's circumstances out of their control, and it's something that will correct as the economy corrects, it's not going to have as large an impact.
Yeah. So another step in doing this is when you go to market, you've got to pretty well have your financials cleaned up. And there's such a thing that's called commingling. And I heard you talk about it a while ago, where you're actually mixing up your personal with your business. And that's one of the things that you're doing when you're presenting this. You're getting the client to clean up the books, clean up the financials. Am I correct?
Correct. Yeah, a clean set of books is critical. And commingling, not only personal expenses, but I've had prospects that have come in here and have had 2 or 3 businesses, and they've got them all on one set of books, one profit loss statement, one tax return, but they want to sell one of those businesses. Where do you start? How do you even value something like that? They're all mingled together. So if you do have more than one business, make sure you keep those separate, because at some point, if you do want to spin off one of those companies, one of those businesses, you're going to need to have the financial documentation specifically for that business. Otherwise, it becomes almost impossible to do a valuation. And if we do figure out a way to do a valuation, to defend those numbers to a buyer or a lender becomes very problematic.
Okay. So in the industries we work with, Jim, we have a lot of people that have, I'm going to call it a combination business. And by that, they may have a retail showroom that's actually a retail operation. Then they'll have a service business that is its own entity. And some may even have a third business like Brandi does, which is they have a fabrication division. So what you're suggesting is these different businesses need to have their own sets of books, their own checking accounts, everything. Is that what you're suggesting?
Yes and no. If those businesses, let's say you've got 4 or 5 of those businesses. I mean, if one depends on the other, okay, now you mentioned you got a retail business and a service business. If the service business is dependent on the retail and vice versa, I mean, basically, it would be hard to separate those 2 businesses. Then it's fine to keep them together. I mean, they each may be their own profit center that you may monitor internally to see, okay, is this department producing revenue? Is this department producing revenue? But if at some point you decide to sell those businesses, and they have to be sold together in order for them to be viable, then it's fine to keep them together. But if you have, let's say the service business and you have another business completely unrelated to that you could sell as 2 separate companies, I would recommend to keep them separate, because at some point you may want to do that. And you have then the advantage to do that. You get to a point where you say, you know what, I want to start throttling back a little bit. I don't want to own 2 or 3 companies anymore. I want to spin off one of those companies. I'll keep 2 of them, or I'll keep one of them. That gives you the flexibility to do that.
Gotcha. So Brandi, your turn. Next question comes from you.
Yeah. So if I'm looking to hire a business advisor to help me sell my business, how do you get paid? Like, is it a percentage like a realtor? And what is like the average cost I might be looking at paying?
Okay. Yeah. We typically work on a success-based fee. We do not get paid until you get paid, when the transaction closes and the money changes hands. As a rule of thumb, our fee is 10%. That's pretty standard throughout the industry. Now, we get into some larger transactions, it may go down. Like we get, above $2 million, we may do it at 8, 9, 7%. It depends. When we get into some bigger transactions, I have one now, for example, it's $4.5 million. That one requires a lot of front-end work on our part and expense. So on those, we will actually get an upfront fee. We call it an engagement fee of, typically between $10,000 and $20,000 to cover some of our upfront fees on a transaction like that, because they're a lot greater than they would be with a smaller, say, $1 million transaction. Also, there's sometimes two pieces to a business transaction: the business itself, and the business may be in a brick and mortar place, and part of that real estate may be part of the transaction too. So let's say you have a business that we value at $1 million, and it's in a building that is also valued at, just for simplicity's sake, $1 million. We would do the business at 10%, but we would handle the real estate piece of it similar to a fee as what a commercial real estate broker would charge, which is usually around 6 or 7%.
Okay, does that answer your question, Brandi? Okay, so
Sure
Terry,
did.
so Terry's asking another question that's up on the screen, and that is, do you assist buyers with finding financing? And what are your thoughts about the seller carrying back some of the paper, which means they would be financing a percentage? So that you see her question, can you address it?
Absolutely. Those are two very good questions. We can help buyers with financing, and we prefer to do that because we deal with lenders that specifically cater to business transaction. I frequently will have someone, and we deal with a lot of first-time buyers. They don't know, so I understand that. But hey, I want to go to Joe at ABC Bank because I've been dealing with him for 20 years. He financed 2 of my houses, financed my cars. I took a loan for my kids' college. They may do a great job with that, but typically they're not geared for business transactions. So we like to get them in touch with somebody that does business transactions. And we have several different options of people that we work with that will, they understand business transactions. It makes it easier to get the transaction completed because they're more familiar with it. It shortens the timeline considerably too when we deal with somebody like that. So we prefer to have someone ask us or use some of the lenders that we deal with. As far as carrying a paper or carrying a note on the business, that's happens. It's fairly common, and is it good or bad? It really depends on the transaction. Now, if someone, for example, comes in and offers you a real lowball price on your business, and it's cash offer, maybe I'll take it. But if they're coming in, they're asking for a lowball price, and they want you to carry 10% or 20%, then maybe not. If somebody comes in, maybe they're offering you full what you're asking for it, and they want you to carry 10%. Well, that might not be a bad deal. There's a lot of pieces of transactions, so you have to look at the overall transaction to really answer that question accurately. And then there's other things you want to look at too. Number one, obviously you want to make sure you have a buyer that has the wherewithal to be successful in your business. What's their background? What's their experience? Because if they don't have that, and their chances of being successful are not great, your chances of getting your money paid back are not great. The other thing is obviously credit. What's their credit score? And the other one is what I always like to look at is if they're buying that business, they're putting a certain amount of money down. How much do they have into the game? And the really key part of that is how much of their net worth does that represent? If somebody's putting money down on your business and it represents a significant portion of their overall net worth, they're going to work very hard to protect that. And as a result of that, they're also going to be able to, as working hard to protect their investment, they're going to be working hard to make sure that you get paid that note. And so there are some advantages and there's some disadvantages to seller financing. When someone comes to you and says, "Hey, will you carry paper on this? Will you finance part of this?" My answer is, what I advise is something we would definitely consider, because you need to look at the whole transaction before you say yes or no to that. Gotcha.
So Sheryl, you're up. What's your next question?
Well, Terry actually jumped into one of mine, so I'm going to take it into another realm here. Okay, you have a company that has hired you to look into their business and sell, and 3 to 4 months, maybe 6 down the road, it hasn't sold, and they decide they want to back out. What are the consequences?
That doesn't happen very often, fortunately, but basically I want to have a good relationship with the seller. For some reason after 6 months they don't want me there, then I probably don't want to be there either. I would handle it on a case-by-case basis, but if I'm not going to have a good relationship going forward with them, unless there's some extenuating circumstances, I would probably try to terminate the agreement if they're not happy. If it's just a matter of they want to get out because, hey, they got somebody that offered them something on the side, or they're talking to another broker, probably not. I would probably say that, what, we made this agreement. I agreed to put forth a solid effort to get your business sold, and I've got a 1-year agreement with you, and we both said that was what we were going to agree to. Then I would probably be a little more reluctant to terminate that agreement. That almost never happens, and I think the reason is, I define the expectations with people up front. I keep hearing you talking about comparing this to a real estate transaction, which a lot of people do, but there's a lot of differences between a real estate transaction and a business transaction. And if I define the expectations and the differences on the front side, I rarely have a problem with it. You need to know that when you're selling your business, it's not like you put a house on the market. I don't know what the markets are like by you, but up here, somebody puts a house on the market, and typically within a couple of weeks, they've got multiple offers. Businesses, the buyer pool for businesses is a lot more fragmented than it is for just about anything else. So we may find somebody right away, and it may take a year. It may take a year and a half. The industry average is 1 year to sell a business. But if I explain that to somebody on the front side of things, and I do my job, rarely does that ever come. I'd be hard pressed to tell you when that has ever come up with me, where someone has wanted out of their contract 6 months into it. So it's understanding what the expectation is, and the time it's going to take to sell a business. I've had some businesses. I just had one here about a month ago we closed on. The first 2 weeks we had multiple competing offers. Boy, I tell you, if everyone was like that, I'd probably still have hair left. But it isn't. Some of them, I also closed on one here 2 months ago. We had it on the market for 2.5 years. Now, there were some, we knew going in it was going to be a challenge because of the type of business that it was. And the challenge got even greater when COVID hit. So, like I said, the average is a year. That means it could be a little less and it could be a little longer.
Got you covered. So, one of the things that I heard years ago, business advice is that when you start a business, you always run it with the intention of selling. In other words, every day that you're running this, you're looking at the value in a sales situation. But most people don't do that. So if someone is considering selling, they've got to stage this business that it may take them up to 3 years. So you just told Brandi a while ago that if she planned to sell at 50 and she's in her 40s, she needs to start this planning now. So what's your advice to most people? Is it 3 years, 5 years, 10 years? What do people need to start working towards this goal?
Well, I would say the sooner the better. And it goes back to what I said early on is understand that at some point you're going to want to sell the business. You want to increase the value of it as much as you can. And by talking to someone like myself or a business coach, anybody, you at least get a working understanding of that. So on a go-forward basis, whether it be 10 years, 20 years, or 30 years, you're consistently working towards that goal. Now, when it comes closer to that time, I would plan on 3 years out. When it gets down to the hard selling and really getting the valuations and starting setting things in place, to say if you're 47, you say, hey, I want to be out of this by 50. That 3 years, I think, is a pretty good timeline to look at. If you get out a year or two earlier, so be it. But what the worst thing that's happened is you wait till you're 50 and say, hey, I need to get out of this as soon as I can. I'm burnt out. I'm fed up. I've had it. I'm having health problems, whatever the case may be, because then it becomes a fire sale. And at that point, it's going to become more stressful and you're going to leave money on the table.
Okay. So Brandi, your turn.
So let's say we've untangled the web of finances and we figure out that a business is grossing $4 million a year. Does that mean, I have no idea, does that mean you sell the business for $4 million, or do you sell the business for $6 or $8 million? How does that work?
Well, the $4 million is relative to, that's top line revenue. You're talking overall sales. That's relative to how much of that $4 million is dropping to the bottom line. For example, okay, let me just give you this. Okay, I got $1 million business that's doing $1 million in revenue. Top line. They're making, say, $300,000 a year in bottom line revenue. I've got a $4 million business, and last year they lost $20,000. Which business would you rather have? Which one's going to have more value? But it really depends on the amount that's dropping to the bottom line. Now, there's always outliers on any of this stuff. This $4 million business, maybe in the past, it's been very, very profitable. But for some reason, maybe it was a health issue, maybe it was a falling out with partners, maybe it was other personal issues where all of a sudden this business took a hit for a year or two, but there's still the base of the base business is still strong, and it can be turned around relatively quickly. Those can be sold. They're difficult transactions to do, but they can be done. But it revolves more around bottom line revenue than it does top line revenue.
Right. So is there a sorry, Jerry, I was just going to ask a follow-up. So there's no multiplier on that bottom line revenue that's just standard?
No, most businesses, the multiplier, let's just say, I'm going to use 100,000 because it's an easy number to work with, are going to be a multiplier anywhere from 1 to 4. Typically 2 is a about where most businesses fall, 2, 2.5. The higher that bottom line revenue, that will push. So let's say you have a business that's got $100,000 in bottom line revenue. For example, it might be a 2 multiple because of the type of business that it is. Now, if I take that same type of business and it's doing more and it has a bottom line revenue of $300,000, then we might be able to get a 3 multiple on that, because those are more attractive businesses because they are more profitable. Not only are they more profitable, but with more bottom line revenue like that, it leaves more for debt service and for a buyer's return or a buyer's salary or income off of it.
That answer your question, Brandi?
Yes, thank you.
Okay, so and remember, we're talking bottom line, not the gross. The gross, that's a trophy out there. That's a shiny thing. But what it gets down to is that bottom line number is what he's saying. So Sheryl, what's your next one?
I'm going to read Terry's first, and then I'll ask mine. Is the multiplier on the top of the P&L or the bottom? I just want to be clear.
On the bottom. And it's on the bottom after we've done the financial recast and added back some of the deductions that are either paper losses or a financial benefit to the owner, or in some cases, maybe a one-time expense. For example, let's say a company went out and bought or did a new build-out and spent $500,000 on a build-out. Well, that's not something you're going to do every year. That would be added back. So once we do all those add-backs, the bottom line, that's the number that we use with the multiplier. So let's say you got that $4 million business, and it's dropping, say, $500,000 to the bottom line. It's got a 2 times multiple. We would value that business at $1 million.
Okay. So
exactly.
Yeah. So Sheryl, go with your question. Thanks for giving Terry's.
Okay. I know the answer to this, but I just want to make sure some of our viewers are clear with this. Does the location of the business have a huge addition or deficit to your quotes when you go in with them?
Not a huge. It will have impact on it, but again, location, it all comes back to profit. Is that location giving, it contributing to the profit? Is it generating profit for me? A great example is I had a restaurant in downtown Milwaukee. Here's on one of the busiest corners of downtown Milwaukee, a traffic count that's through the roof, and he thought that would make his restaurant worth a ton of money. I looked at his financials, and he was barely breaking even. So how much is that location worth at that point? It's not worth that much unless it's generating the revenue to make it worth that amount.
Sheryl, that answer your question?
Yes, I was fairly firm on that, but a lot of people, they look at their business, their location in a whole new set of glasses than someone say you would. So, and I think that's where a lot of people get messed up when they start assuming what their business is worth.
Yeah.
Right. Well, you get that drilled into them. You hear that thing about real estate, for example. What is real estate all about? Location, location, location. That doesn't really apply to business. Probably the biggest impact it has on businesses. For example, I just sold a business up in northern Wisconsin. Very sparsely populated. There, it has a little bit of an impact, not so much on the value of the business, but the timeline to sell that business, because the buyer pool is significantly less than it would be in a metropolitan area like Milwaukee or Waukesha, where I'm located right now.
Gotcha. So, Jim, one of the things I've got down here is if you're going to do this, to consult a reputable business broker with a proven track record of success. And a lot of people may look at a broker like, well, why should I get a broker? He's just going to get a piece of the pie. He's just going to get a cut out of it. What's a broker going to do with me? And I'd also advise them to list. That's one of the reasons I like Sunbelt. Y'all have a national network there of locating buyers. So why should a person go? What's your advice? Why should they contact someone like you to take them through this process?
Yeah, us rotten old brokers, we want to get paid. Isn't that terrible? For one, we get the exposure to the business that somebody's not going to get on their own. The other thing is it's a time-consuming process. You're running a business and you're going to try and sell it at the same time. What's probably going to happen is it's going to affect the success of your business. It's going to start taking time away from you running your business on a day-to-day basis, and you may see a decline in sales, which is going to make the business less valuable. So, what we bring to the table is, the expertise to know how to sell the business, how to market it, how to bring people in, how to maintain confidentiality, and, to take away a lot of the work that has to be done to sell the business, like vetting the buyers. If I come to you you're a seller, you're under contract with me, I may come to you with a buyer that wants to meet with you. I may have gone through 20 or 30 other buyers that don't want to move on to that step, or are, financially or for one other reason are not a good fit for that business. And, that's time that I've spent that the business owner does not have to spend. They can continue to spend that time operating their business and keeping their business successful. And that's critical, because the last thing you want to do when you put your business up for sale is operate that business any different than you have. If you've been operating successfully, you want to keep your foot on the gas pedal, keep that business moving forward, and keep that business successful while you're going through the sales process, or it could have a negative impact on the business.
Gotcha. Brandi, your turn.
So, how do you find the buyers? In other words, like, do you have a pool of people that come to you and say, hey, I want to buy a business, I want a blue collar business or whatnot? And then, or do you do that and you market to, like, so we're Chimney company. Do you market to other chimney companies around the United States saying, hey, if you're interested, I know a business for sale? How does that work?
Well, it's multifaceted, and you touched on some of them. One thing we do is, again, when we do put our marketing materials out there, we use a kind of a generic piece that just tells enough about the business. So we use a lot of business websites that are dedicated to sales of business, including our own Sunbelt website. But it'll tell about the business. It'll tell what kind of business it is, some basic numbers, what it's selling for, what the top line and bottom line revenue is, and just a brief description, enough that if someone looks at it, they can say that's something I might be interested in. But at the same time, it doesn't identify which business it specifically is, so we maintain that confidentiality. So that's one facet of how we market. The other is we have a database, working with people day in and day out. We have 5 brokers just in our office, and we have thousands and thousands of names in our database. We'll go back in and mine that database and say, okay, who's inquired about a business like this over the last 6 months or 12 months that may still be in the market? Look for it. We'll reach out to those folks. Myself and almost every other broker in here, we usually got 5 or 6 very qualified buyers who we're working with very closely to try and find something that we'll reach out to. I'm also networked in with a number of accountants and attorneys, and they know, if they have a client or somebody that's looking for something. I'm involved with a number of different networking groups and chamber of commerces that I talk to. So, because the buyer pool is so fragmented when it comes to business transactions, we can't leave any stone unturned. We have to use all those different vehicles to market the business and find a buyer.
Gotcha. So Sheryl, your turn.
Basically, that's all the questions that were really eating on my mind. I'd like to give Jim time to maybe give us a few pointers and things that he has on his mind. I know it's hard when you're getting asked a lot of questions. You don't really have time to say what you would tell people.
Well, if you want me to talk, we could be here all day. I keep it brief. The biggest thing, and this is something that we talked about here several times, and is the plan ahead. If you don't have an exit strategy, you don't have an exit plan, and 90% of business owners don't. I was guilty of it with my first business. Sit down with a business broker. Most of them, myself included, we're not going to high pressure you into selling your business. We're doing it for two reasons. One is so you know where you are at today and you understand how your business is valued. So when that day does come, whether it be a year from now or 10 or 20 years from now, you're much more prepared from it. And from a self-serving standpoint, after you know that, you come back to me to sell your business, it's going to make my job a whole lot easier too to get your business sold. So preparation is a big key. If you're a business owner, don't feel bad that you don't have an exit strategy. You don't have an exit plan. The vast majority do not. But get in that 10% that do. Reach out to a business broker. Say, hey, I'm maybe not ready to sell yet, but I would like to come in and talk to you to find out what I need to do so when that day comes, I'm prepared. Most business brokers would be happy to sit down and talk with you on something like that. And if they aren't, call another one.
I appreciate that.
Okay. So back to me. So Jim, one of the things that I look at is a business where the owner works in the business. He has a job. Is that the type of business that people want? I call it, people want to buy a business. They don't want to buy a job. So as you look at that, is that owner's salary a part of the return of the business, or is it strictly on the bottom line profits?
Yes. Now there are some that it depends on the type of buyer. It depends on the size of the business. Typically, most of your Main Street businesses are owner-operator businesses. The buyers for those are also intending to come in and owner-op. So that when we're talking about add backs and financial recast earlier, on a business like that, we would typically add back the owner's salary. So let's just say the owner's drawing $100,000 a year. We would add that back into the bottom line revenue because it's the type of business where somebody comes in, the owner's going to exit, and the buyer's going to take over that role that the previous owner did, and that money that previous owner was taking as salary is going to go to the new owner of the business. Now, there are some businesses that are larger where we get private equity groups or venture capital type firms where they're buying them, and they're not going to do that. Those we generally don't add back because they've got managers in place. Those people are going to stay in place. And somebody's going to buy it, and they're going to have someone else run it for them. So that depends on the type of business and what the intent is of a buyer and a seller.
Okay, so the salary of the owner is considered as part of the value and the return of the business. Is that what I'm hearing you say?
In most cases, yes. Yeah, in most cases. When you're talking about that, too, it just brought something else up, and we forgot to talk about either when businesses are being valued. Is when you've got a business that is so owner dependent that you are the business. When you walk away, the business is going to cease to function. Very difficult to sell a business like that. If you're in a position like that where you are such a critical component to the business, find a way to start delegating so that business can run without you. Because that's going to, if you are that critical to the operation of that business, is going to make it very difficult to sell.
So like if you were the top salesperson in the business, you were bringing in, let's say you had 4 salespeople working for you and you were bringing in 60 to 70% of the sales as the owner, then you leaving there means that is going to be gone. That's going to be a hard sell. Would I be correct?
Yes, but if you've got 3 other salespeople, the question then would become, well, if you leave, can they pick up that slack for you? Or do you have such a relationship with these people? I'm talking about more of well, for, a lot of them are one-man operations. Say you have a business where maybe you're a manufacturer's rep, for example, and you are a salesperson like you just mentioned. So you go out, you're basically selling 100% of the business. Now, when you leave, what's left? What is the business? You are the business.
Yeah, it's kind of like Tommy Boy. If you ever watched the movie Tommy Boy and his dad, his daddy died, and Tommy Boy was left in charge, and we got a problem now. So, Brandi, your turn.
So I think what I see a lot in our industry, because it is a lot of smaller businesses, is they piecemeal everything out. So they'll sell the work truck separate from the website, separate from the phone number, separate from the contacts. Do you deal with anything like that, or do you recommend in that case that the people just handle it on their own?
No, you're talking about basically selling off all the hard assets of the business. And in some cases, more than I'd like to see, when I do evaluation, I'll look at a business and it's just not saleable, it's not making money, but their balance sheet shows they have a lot of hard assets. They got vehicles, they've got equipment, but they're just not producing any profit. And in that case, that my suggestion is either go out and sell that stuff on the open market, have an auction, whatever. That I don't get involved with typically. There are exceptions if it's something where all that equipment maybe as one piece being sold all together might have some value to other businesses. I might get involved with it, but more often than not, I would say, like I had a machine shop a while back. The guy had some great equipment, some really nice stuff, late model equipment, worth several $100,000, but the business just was not producing. I suggested to him, either try to sell that on the open market yourself, or get, do an auction or something of that nature.
Yeah. So Sheryl, did you have anything else? You said a while ago you were out of questions, so I didn't want to skip over you if you had anything else.
No, he made a reference to what I was talking about earlier when you were down to so many people, basically the owner being one of the few people in the business, when I was talking about trucks being dissipated down. At that point, I'm assuming that's where it becomes extremely hard when you've got an owner and maybe one person in the office.
Yeah.
It does. It does become difficult. Now, again, every business is different. That may still be a very saleable business. Somebody may look at that and say, hey, there's even with, one or two people there, they're still making a decent profit. And I can come in and take over for that person that owns it now, and we're going to have a transition agreement where he's going to stay for 30 days or 6 months or whatever the case may be, depending on the complexity of the business and how long it's going to train a new person. And there may be opportunity for him to, after they take over, to start bringing in more people. So it doesn't make it unsaleable, but it does make it more difficult. And again, it depends on the type of business.
Yeah.
So let me carry that just a tad farther, Jerry. So when this is happening, do you see quite a few business having the owner or one of the employees stay on for a period of time? Is that normal?
Almost always there's going to be some kind of transition, and it will depend on, number one, the complexity of the business being sold, and a lot of times it depends on the buyer. So if you have a buyer coming out of that, say they work for machine shops. I was just talking about a machine shop. Let's say if somebody is coming out of that industry that's buying a machine shop, they are going to get up to speed probably pretty quick. They're probably going to want a transition agreement of maybe 30 days. Show me where everything is, introduce me to your key customers, help me, start to transition those relationships. Give me the keys to the doors and the passwords to all the computers, and then get the heck out of my way. Now, you may have somebody coming into an industry that's a little more complex, and somebody that's coming in, maybe they've got a good set of business skills, but not specifically in that industry, where you're going to need to stay with me for a year because I only have to learn the business aspect of this. I have to learn the actual part of this business, how to operate this type of business, the technical portion of the business. So that's negotiated on again, on a case-by-case basis, depending on the type of business and the type of buyer.
Okay. So my question next is on inventory. I know when I put my business on the market, we had a number of inventory. This was the dollar value of the inventory. And what they said was at the time of closing, there would be a inventory done. And if we were under that amount, we'll just say it was $500,000. So if we had 450,000, then we're going to have to take 50,000 off because it's not there. And if it was over that point, then that had to just go somewhere. I would have to either give it to them or whatever. Is that how inventory works?
Yeah, pretty much. Yeah, that's always a challenge. Inventory is always something that, how are we going to, move forward on inventory? How are we going to value the business? Say, well, the business typically carries, for example, let's say typically it's $1 million. So let's base your letter of intent or your offer of purchase on $1 million worth of inventory. When we get to closing, maybe we do an inventory the day before, the day of, and then we'll do an adjustment at that point. If it's at $1.2 million, we're going to add that to it. If it's at $800,000, we're going to deduct out of that. So that's typically how it's done.
Got you covered.
And another one too is work in progress is handled kind of the same way. If you have a business that say they do a project where the project maybe take 30 days, and they've got projects that are in process, work in process. How do we handle the work in process? That's a little more complex. Okay, is the job 50% done? Is it 75% done? And those we got to handle on a case-by-case basis. And that one can be, you got to get both parties talking and say, okay, here's what we're going to do, and we're going to go 50% on these. We'll go maybe 25% on these, and maybe we'll go 10% on these. So they have to be, you have to look at them on a case-by-case basis.
So that's all off what you feel that function, you put the deal together. You're that intermediary to make that. That's part of what you're doing to earn your commission is making this deal work. Am I right?
Correct.
Okay.
Matter of fact, I've even gone out and helped on inventory the night before a closing.
I hear you, brother. So, Brandi, this is your last hit, sweetie. What's your last question?
Well, so I was trying to think of it like if I was a buyer, what would I want to know? And so, like, one of the questions that I came up with in my research is the business involved in any ongoing lawsuits? Is that something I assume that you deal with that a lot? Is that something that you help with? How does that work?
Yeah, we don't deal with it a lot, but it's a question we ask on the front side. We have what we call a seller disclosure document. And one of the things on there is there any pending litigation, or are you expecting any pending litigation? And if they are, a buyer has to make full disclosure on that. Is there a possibility they may try to hide it? They might, but if they do and it comes up later, that's a material fact that they haven't disclosed. In that case, the buyer's got a pretty strong case for a lawsuit. That can't always happen. I mean, there are no absolutes. It doesn't happen very often. It's a very small percentage of the time it does happen because, mostly people they're business people, obviously, and they know that at some point, if they don't make the disclosure, sooner or later, it's going to come back and they're going to have to deal with it. There's other things too. I mean, it could be a lawsuit. It could be a pending unemployment compensation issue. There could be maybe environmental on the business. Are there any proposed or zoning changes? That anything that's going to have a material effect on the business, whether it be a positive or a negative effect, is something that we ask. We got a whole list of stuff. Some applies to every business, but we have a whole list that we ask everyone to make full disclosure on that before we even go ahead with the marketing of the business.
And Jared, can I ask just one piggyback question, and then I promise I'll be done? And it may not be a question for you. It may be a question for an attorney. I don't know. So if I am selling my business, is there a certain period of time afterwards that I should keep like my liability insurance for example?
That's probably a better question for a lawyer, because if that comes up, that's who you're going to have to deal with. And I'm not a lawyer, and I really don't want to give you legal advice. I know as a business owner, twice myself, I kept my records for a long, long time. Matter of fact, my first business, I sold it 20 years ago, and I think just last year I shredded and burned the last box of records I had for that. I feel comfortable keeping them for 10 years. I figure after 10 years, I'm probably okay, but I would consult, with legal counsel on something like that to get a definitive answer.
Yeah.
Thank you.
Randy, I would also talk to your insurance agent because there's such a thing as claims made basis and when the work was done, those kind of things. And that's going to actually roll into my last question for him in just a second. So Sheryl, did you have one last question for Jim?
No, I think I'm good. I know we're running close on time, and I know you do have another one.
Okay, so here's my last question, Jim, to you, which we're probably going to be talking about. Most companies are going to be incorporated in some form or another. Could be C, could be S. But usually when I talk to a client, if they were considering purchasing, I tell them that we are purchasing the name, we are purchasing the assets, but we never want to purchase the corporation itself because the corporation carries liability from the past. And if you purchase that corporation, you've just bought all the past liability issues that could go with this. So would you agree with that that's the way to do this in small business, that you purchase the assets, the business name, the right to use it, the phone numbers, that's the business, but not by the corporation?
You summed it up perfectly. 99.9% of the transaction we do are asset type sales that you just described. The only time that we've ever done any type of a stock sale on a corporation, we had a situation on one last year. They had a number of contracts in place, long-term contracts, and it was easier rather than trying to get re-signing all of these contracts. We were able to do it as a stock sale. So when somebody bought that business, they bought the stock, those contracts came along with it. They did not have to be transferred. That being said, that's not always the case either. I just sold a business where there were some contracts in place, but a lot of times, even if we'd have sold that as a corporation, there's language in those agreements that says if the major shareholders of that corporation change, those contracts become null and void. So they still have to be re-signed. So again, we still had to do it as an asset sale. So yeah, 99.9% of the time, an asset sale is definitely the way to go.
Good. So Brandi, did you learn anything today about exiting and selling the business? Because you've got a business there that you and Jeremy may sell one day. Did this help you?
It did. Yeah. Thanks for clarifying a lot of questions that I've had rolling in my head for years.
Okay. So Sheryl, same way. You own a manufacturing plant. You own a manufacturing business. If you were considering selling, has the information Jim shared been helpful for you?
It definitely has been. I think this is going to be super for anybody that has this in their future.
Okay. So Jim, again, like I said, I decided to kick in on this a couple weeks ago because I'm seeing people that are reaching that age. They're wanting to sell the business, and I'm watching people sell their assets. And I hate to say it this way, but it's almost what I call courthouse value, which means what it would bring at a auction. And you see people that have poured 20 years, 40 years, blood, sweat, and tears and everything else into there. And that's what my goal was in this, was to share with people how you get set up. This is not a quick decision. It's like Friday, I'm done. Let's sell it all. I'm out of here. It's not going to benefit you. So as my last question to you is, you work with Sunbelt Business Advisors, and that is a company that I have recommended a lot for a lot of reasons. You're national, those kind of things. Am I well-rounded in that recommendation, Jim? Would you agree with what I'm saying?
Yes, I would agree.
Okay.
It is really heartbreaking when you see somebody, like you said, that's been 20 years in business, want to get out, and they end up basically giving it away.
And we do. And, right. I see it a lot of times. I'll see a business. I'll give you an example. A hardware store, been in business for 100 years in the family. And because of the change in the hardware business and the big boxes, and they're still trying to operate as that 20-year-old hardware store. And they end up just one day, we're done. We're closing it out. Okay. So Jim, they're asking for the contact information for Jim. Jim, can you tell her how to get in touch with you? Because this may be a lead for you here.
Absolutely. I can I can either verbalize it right now, or if you prefer,
Well,
I can put it in the chat.
Why don't you put it into the chat and it'll go out there, Jim, if you want to. There's a chat button over there. Just post it into there.
All right, I'm pulling it up right now. I've actually got it. I can cut and paste it in there, and everybody will have it. It has my
and Jim and Terry, so you know, I'll be glad to send you his contact information also. I know Terry personally. She's very well. She is in San Diego. She has a family business, and you know, she's asked a lot of good questions today, so that's really great.
Yeah, hold on, I'm getting it. All right, so we'll have it on there in about 6 seconds. And there you go.
Okay.
So, yeah, feel free to contact me. Being a business owner myself, I love talking to other business people. That's why I love my job.
Yeah.
The only part of it that I don't like is having to tell somebody their business is unsaleable. So that's why even a bigger reason why I like talking to people about their businesses and how they're valued, because that more I do that, the less I have to do the other. So
so how far are you from? So how far are you from Milwaukee, Jim? You told me the town you're in. How close are you to Milwaukee?
Yeah, we're actually in Brookfield, it's a suburb of Milwaukee. I can look down the street here and see Milwaukee, so we're not far away.
Well, so you know, I'm in Milwaukee quite a bit. I have a client in Cedarburg, so I'm actually right through the middle. I fly into Milwaukee Airport. I was there about 2 months ago, so very familiar going through there. But like I said, Sunbelt is pretty well a national firm. Y'all got a lot of agents around the country, and it's a really good way because you got to get out and let people know. So y'all have a database of buyers that are looking for business. Am I correct?
Correct.
Okay. So, Jim, I want to thank you for your time today. This is really, really helpful. And actually, I'm doing an article for a trade magazine. Terry, it'll be in Sweeping Magazine, and it's actually entitled, "What is Your Exit Plan?" So you're going to see an article in the January issue about this. So, Jim, I want to thank you for being with us today. I want to apologize to everybody because our sound system was malfunctioning. So you're actually listening to Jim through my phone that we're then going to the microphone. So we apologize if you're having trouble hearing this today. So this has been the Chimney and Fireplace Success Network. And we do this every week. And our whole goal here is, and why we do it, is to share business information with you. And if we can help you in any way, reach out to one of us here at CVC Success Group. You can see that our email addresses are right there on the screen at any time. And with that, we'll see you next time on the next episode of the Chimney and Fireplace Success